Welcome back, everybody. For those that do not know me, I am Chris Seveney with Seveney Investments. And today I want to talk about the most recent conference I was at called Note Expo. Over the last 3 months, I've been traveling a lot to different conferences, kind of doing that travel circuit. We traveled more the last 3 months than probably the last 10 years. But it was very interesting because the conference had between 200, 250 note investors and really got a better sense of the pulse for what's going on in the industry. One of the things that I thought was very intriguing were to discuss other funds and some of their fund structure. I've shot previous videos about current funds and other asset classes having a fund to raise debt to invest in that product. For example, a multifamily is coming up for that loan is maturing. So instead of doing a capital call and trying to refinance with the bank, they're actually raising money from investors to fill that void. Now, what's interesting on the mortgage note space that I found unique were the funds that got their money from lines of credit through banks. And a lot of those funds were investing in commercial properties, which were performing loans. They were getting lines of credit. So let's say their line was prime plus 2.5%. Well, when prime was down in the low, call it 2, 3, 4, 5%, they're borrowing money at 5 to 8%. And they make that spread of, let's say they're making 10 to 12% on their loans. What's happening today is their lines that they have with these institutions are now at 11 and 12%. They're actually higher than the loans they're giving. So it's similar to example of multifamily of buying an asset, paying 8% on a loan where your cap rate's 5%. The more money you're borrowing, the worse it is for you. So what does that mean? It's causing a lot of heartache with these funds that were getting leverage. Now, for those that haven't seen our prior videos at 7E, that's one of the things where we, again, differentiate from each other is we don't have debt. So we don't take on lines of credit from banks at this point in time. We don't have any other leverage. Our investors are preferred equity and they're in first position. I wanted to share this story with you because, again, when you're looking at a fund to invest in, you need to understand that risk and where you are in that capital stack and understanding the type of money that is being leveraged, because if it is variable, it can really have a significant impact on the space. And we're also now seeing that actually in the mortgage, the private credit space, which we hadn't seen before. So just a reminder that not all funds are created equal. And it's very important to ask the question, what are you investing in? What is that capital stack? Is there leverage? And what does that look like? For more content, more informational videos, make sure to follow us on YouTube, LinkedIn, and at 70einvestments.com. Thanks and have a wonderful day.